Okay, good morning, everyone. Thank you for attending this webinar on mergers and acquisitions. My name is David Hankus. I'm a Vice President here at Technomic. By way of background, I've been with the firm just over 18 years and work with leading suppliers, distributors, and trade associations to help them identify growth opportunities in today's challenging marketplace. I'm delighted to have the chance to talk with you today. Before beginning, I want to acknowledge our partnership with IFTA in putting these webinars together and to thank them for the opportunity to collaborate on the Technomic Talks series. A couple of housekeeping notes before we begin. Everybody is on mute. Because this is a relatively short webinar, 20 to 25 minutes, there won't be an opportunity to ask questions, but if you do have one, feel free to enter it into the website and we will respond to you later with our answer. Okay. Well, we have four objectives for the next 20 to 25 minutes or so. The first is to review food industry merger and acquisition activity, and we're really going to focus on some of the key deals over the last, call it 18 to 24 months in 2013 and into 2014. Clearly, one of the things we want to do is discuss drivers for the current activity. What's causing all of the merger and acquisition activity in the food industry right now? And of course, we want to share some conclusions, implications, final thoughts with you at the end of the webinar. First, I think it's important to note that the food and really drinks industry has been globalized to an extent like never before. While many of the acquisitions we're going to talk about today have U.S. implications, I think the broader point is that globalization of the industry is driving the need for relevant brands, relevant products. It's driving the search for new markets and new growth vehicles, and ultimately leading to greater consolidation among many food and beverage verticals, including manufacturers, restaurants, distributors, all of the areas we're going to be talking about today. If we look back several years, the food industry was relatively quiet. Now, obviously, there were deals going on, and there's always been deals occurring, but a lot of the high-profile occurrences were, I would say, relatively rare. Many industry observers, though, trace much of the explosion in mega deals to early 2013, when 3G Capital, together with Berkshire Hathaway, acquired Heinz. This was obviously a major global acquisition, with the Brazilian private equity firm joining with Warren Buffett's global investment firm to acquire one of the truly iconic global brands in a deal valued at $28 billion, including debt. Obviously, both companies are no strangers to acquisitions and had previously joined together to acquire Burger King in 2010. And where we sit now, and as we'll talk about as we go throughout this webinar, this hasn't necessarily led to more deals, but what it has led to are more and more big deals. In fact, the value of transactions within food and beverage is expected to total more than $100 billion this year, surpassing last year's record high $97 billion. So clearly we're in an era where there are a lot of big deals and a lot of money flowing into the food industry. The Food Institute does a great job of tracking relevant industry M&A activity, and we rely on their numbers to look at how the last several years have unfolded. In 2013, despite what I said on the previous slide about record transaction value, it's interesting to note that the actual number of transactions was down slightly. 281 total deals in the food industry in 2013 versus 287 in 2012, a decline of about 2%. If you look more historically, these numbers are more in line with the averages that we've seen if you go back to 2009 and to some degree 2010. 2011, as you see, saw an abnormally high number of transactions, 381, which was the culmination of 2 years of 20% growth in deal activity. When you peel back the onion on that a little bit more, a lot of that was driven by C-store, distributor, and packaging and equipment deals. And we'll get into some of that when we talk about distributor deals a little bit later in the webinar. This table shows M&A activity as tracked by the Food Institute by major food industry segment. While I noted on the previous slide that the overall number was somewhat down in 2013, I do want to highlight a couple of things. First, processor M&A activity, which includes anyone from bakers to brewers to dairy to meat and other food processors, saw a huge leap in 2013 with the number of deals up 26%. We're going to talk about a number of them going through this presentation, but as I mentioned, these deals are also getting bigger, and these are driving much of the record high in terms of the total deal value. The other thing I want to point out is broker consolidation. 2 to 3 years ago, there was really little to no activity on this front, and now we've seen a huge spike in the number of deals. not only in 2012, 2013, but as we carry on into 2014. Broker consolidation has followed consolidation in other areas, including distribution, retailer, manufacturer. And again, we'll be talking about that a little bit more in this presentation. What's been the basis for rising transaction values and the degree of value that we've seen over the last couple of years? Generally speaking, when you look at M&A activity, all low growth, highly fragmented supply chains and verticals eventually consolidate. We've seen it in banks, airlines, even the hardware industry. Certainly the food industry has seen its share of consolidation, and given that we're in a period of sluggish growth with, I think it's fair to say, fairly fragmented competition throughout the value chain, it's no surprise that we're seeing a lot more merger and acquisition activity going on within the industry. Companies that aren't experiencing top-line growth still need to show revenue growth as well as, and perhaps more importantly, growth in bottom-line profitability. So we see deals that are driven by things like cost savings and synergies, extracting cost savings from acquired companies where the acquirer knows that there are some immediate benefits in putting the two companies together. We see one of the drivers being access to new markets or new technologies, finding those new avenues of growth or new products that are going to move the needle in a sluggish growth environment. Similarly, portfolio expansion, leveraging current customer relationships or acquiring access to new brands or new areas that they can focus on to drive growth. One of the drivers might be enhanced stature or heft, becoming a larger player, particularly as competition and customers consolidate. This is often a strategic requirement in today's marketplace. Strengthening or obtaining brand leverage. As we'll see, brands are one of the key pieces of any deal, and acquirers are willing to pay high multiples for brands that have a strong position in the marketplace. And finally, I think it's important not to understate the importance that many companies, many private equity firms have extremely strong balance sheets with a great deal of cash on hand, and this allows for larger deals to be made. One of the other things that goes part and parcel with is the historically low interest rates that have also helped drive M&A activity over the last several years. Over the next couple slides, I want to take a look at some of the big deals and what's been driving them. And we're going to start on the restaurant side of the food industry. There have been a number of true acquisitions and investments by one restaurant company buying another. A lot of this is driven by diversification, either getting into faster growing segments or acquiring strong brands that may complement top line and bottom line growth objectives. One deal I think is very interesting is Buffalo Wild Wings investing in a relatively new concept called Pizza Rev, a fast casual, sort of upscale pizza chain out of Los Angeles. Buffalo Wild Wings is one of those concepts that's hitting on all cylinders right now with its own concept. It was up 13% last year. It's got sales of $2.8 billion. Yet even that chain recognizes the need to invest in new segments and fast-growing niches, and it sees fast casual as a huge opportunity. By way of note, Technomic believes that fast casual pizza is really an up-and-coming growth segment within the restaurant space with a lot of growth potential. Other deals, such as Landry's acquisition of Mastro's, are really a portfolio addition play. High-end restaurants are doing real well right now, and Landry's adds this concept to a portfolio that includes McCormick and Schmick's, Saltgrass Steakhouse, its namesake Landry Seafood House, as well as some hotel, casinos, entertainment concepts. So really building upon what it's already doing well. Somewhat similarly with Ignite, who made the largest restaurant acquisition in 2013, Macaroni Grill. Ignite, which owns Joe's Crab Shack, Brickhouse, believes that it can drive some operational improvements to better performance, and it also takes their total portfolio business to almost $1 billion in total revenues. So we see here really sort of a consolidation, an investment in some new growth opportunities, and some portfolio expansion driving a lot of the restaurant diversification. Private equity interest in and ownership of emerging and mature restaurant brands continues to be strong as well. Private equity views restaurants as opportunities to acquire stable businesses that perhaps are underperforming and turn them around. However, many of the large private equity firms have built impressive portfolios if you look at it. The complete list would probably be too long, but we generally look at really 4 private equity companies as the leaders in this space. The first would be Roar Capital, who added CKE with sales of about almost $4 billion last year. It also added Miller's Ale House. When you look at their existing portfolio, it's pretty impressive. especially when you consider that Focus brand, which is one of the logos there, also includes Auntie Anne's, Carvel, Cinnabon, Moe's Southwest Grill, Schlotzsky's, franchisor of Seattle's Best. So Roark Capital certainly has an extremely impressive portfolio of restaurants. Johnny Rockets was sold to Sun Capital Partners in the summer of 2013. And when you look at that private equity firm, it also runs several other restaurant brands, including Fazoli's, Boston Market. Their investment strategy, what they believe in, is investing in companies which typically have the #1 or #2 market position in their industry, as well as some other long-term competitive advantages. And I think when you look at that portfolio, most of those would fit in with that investment strategy. Darden Restaurants is selling Red Lobster to Golden Gate Capital for about $2.1 billion in cash. That's expected to close early next year. It's going to join CPK as well as some other retail brands such as Eddie Bauer, PacSun, Payless Shoes in Golden Gate's portfolio. And so they're within the broader restaurant/retail space as well. And finally, Sentinel Capital Partners is acquiring Checkers Drive-In, which operates 800 Checkers and Rally's restaurants. Sentinel previously invested in chains like Huddle House, Nukes, TGI Fridays, and when you look at their investment strategy, they tend to focus on middle market investment opportunities, usually under $50 million in EBITDA, but kind of in that middle market area. But as I mentioned, overall restaurants are seen by private equity as a stable, generally safe investment, and we certainly believe that the activity seen here by private equity is expected to continue. A discussion of restaurant M&A activity wouldn't be complete without the latest salvo of Burger King bidding to acquire Tim Hortons. Most recent deal was announced recently, and it certainly caused some ripples both here in the U.S. as well as in Canada. Burger King's proposed acquisition of the donut and coffee icon Tim Hortons is going to make an entity that has over 17,000 locations, and it'll be the third largest quick service chain globally behind McDonald's and Yum brands. Strategically, the stated objective is to give Tim Hortons the ability to accelerate global expansion, as they're pretty much tapped out in terms of Canadian growth opportunities, and obviously they've started coming down here into the States as well. Burger King gained some access to breakfast know-how and potentially a strong coffee brand to help accelerate breakfast sales. But I think the thing that clearly got most attention was the so-called tax inversion, where Burger King would move its headquarters to Toronto to take advantage of a lower corporate tax rate on global sales. This is one of those deals that, again, when you look at some of the big financiers, 3G, the owner of Burger King, and Berkshire Hathaway is providing about 25% of the financing, and in return is taking preferred shares in the new company. Staying on the retail side of things, moving a little bit more into the food retailer side of the business, and again, this part of the business has been relatively flat as well, the grocery channel. The most notable acquisition last year was Kroger's purchase of Harris Teeter Supermarkets, the fourth largest supermarket acquisition of the last 10 years. Together, these companies are going to operate over 2,600 supermarkets in 34 states in the District of Columbia. Safeway also agreed to be acquired by Cerberus Management through AB Acquisition LLC, which is the owner of Albertsons. This is an even bigger deal. It's worth about $7.64 billion in cash, and pending some other transactions related to the deal, it could top $9 billion. This would create a merger or a network of over 2,400 stores, 27 distribution facilities, and 20 manufacturing plants. And so that's expected to close in the fourth quarter of 2014. Speedway, if you look more on the convenience store side of the business, which is a subsidiary of Marathon Petroleum, is going to acquire Hess for about $2.4 billion. And they're going to have revenues of over $27 billion with about almost $5 billion of annual merchandise sales at more than 2,700 retail locations. A couple that aren't necessarily in the food space, but I think they impact the food industry. One is Walgreens, who created quite a stir earlier this year when they announced they were buying the 55% of European drugstore chain Alliance Boots that it didn't already own and was going to move their headquarters out of the U.S., again going back to that tax inversion that we talked about on the last slide. While they bowed to pressure and relented on actually moving out of the U.S., the deal itself was still moving forward. And then Dollar Tree, and we don't necessarily think of the dollar stores as a food industry play necessarily, but dollar stores and discount stores are getting very involved and active in selling branded food items. And so when you look at the Dollar Tree Family Dollar merger, where Dollar Tree agreed to buy Family Dollar for about $8.5 billion, it's going to have over $18 billion in sales and actually more locations than any other retailer in the U.S. And so, again, a lot of the sluggishness on the retail side is causing some of these companies to come together. Beyond restaurants, the one area that tends to get a lot of attention and press are the processors. And as I noted, the number of deals here have been increasing over the last couple of years, both in number and seemingly in value as well. Quick review of the landscape indicates that most of these deals are driven by the need, either real or perceived, to achieve greater scale or to diversify and expand the existing product portfolio. One of the most recent examples is Tyson's acquisition of Hilscher Brands. This was probably a bit of a surprise, as Hilscher originally put a bid in to acquire Pinnacle Foods, and that deal was announced in mid-May earlier this year, but Hilscher pretty quickly had offers in the form of buyout proposals from Pilgrim's Pride as well as Tyson. Tyson finally won, reaching an agreement to buy Hilscher in a deal worth about $7.7 billion. And clearly Hilscher becomes a valuable asset in Tyson's continued push into branded products, as well as helping it build build share and grow product in the growing breakfast market. Campbell's has been extremely active, with much of its activity focused on smaller players that give it renewed access to growing upscale markets. Kelsen Group is based in Denmark. It's a producer of baked snacks that are sold in 85 countries. Particularly, it's a market leader in the sweet biscuits category in China, which gives Campbell a leg up in that market. In 2013, Campbell's also bought Plum Organics, a provider of premium organic foods and snacks for babies, toddlers, and children. Plum is the #2 brand of organic baby food in the U.S. and the #4 baby food brand overall. This acquisition is giving Campbell a platform to extend its core categories of simple meals, snacks, and beverages and help drive sales of kid-focused products into the retail and food service channel. B&G has been another one that's been fairly active over the last couple of years. It acquired Rickland Orchards, which makes Greek yogurt-coated granola bars and bites, for about $57.5 million. These types of products, Greek yogurt, handheld bars, are extremely on trend right now with the consumers. And in addition, B&G acquired Robert's American Gourmet Food, which is also known as Pirate Brands, for about $195 million in cash, which further expanded its presence in the upscale natural snack market, and also acquired True North, a nut cluster snack company, which also furthers that objective. Finally, as many of you know, the carbonated soft drink market hasn't been great for a while. So what to do if you're the leading player? First, an acquisition that could potentially get you into another delivery system. Green Mountain, which gives Coke access to the Keurig delivery system and all that goes along with that. In addition, it was just recently announced that it would invest a 17% stake in Monster energy drinks, which will then move the Monster brand into the Coke delivery or Coke distribution system, and Monster is in turn transferring its non-energy drinks to Coca-Cola as well. So again, diversifying into some faster growing product categories. Another one not shown here that we just became aware of is General Mills acquiring Annie's, a maker of organic and natural foods, for about $820 million. This is just another example of a manufacturer paying a premium for a company that will build out its organic portfolio. It's clear there's a lot of interest in these types of companies right now. So while there's been a fair number of big deals, it's just as fair to say that much of what processors are doing right now is looking to tap into innovative, smaller growth companies that have an established brand that can be used to accelerate growth. I mentioned earlier that food and beverage is global, and I think that's very evident when we look at the beverage alcohol space. Acquisitions, for the most part, while having implications in the U.S., are intended to generate and maximize global scale, tap into emerging markets, or round out a portfolio that may not be on trend with where the consumer is moving. Great example is Japanese firm Suntory buying American bourbon icon Beam, which includes not only Jim Beam, but also Maker's Mark, Sauza, and others. If you've been watching the beer industry, you know that major brewers have struggled to achieve volume growth, with a lot of excitement in craft beer as well as certain imports like Corona. Anheuser-Busch InBev completed a $20 billion purchase of Grupo Modelo last year, buying the half of Modelo that it didn't already own. But what it had to do after the Justice Department had some objection was to sell Modelo's entire U.S. business to Constellation Brands, meaning it does not directly benefit from the success of Corona here in the U.S., but certainly benefits from it globally. And something else we're keeping an eye on is Treasury Wine Estates. It's an Australian company, but you may know them best for their Beverage brand here in the U.S. They made news a year or so back when they had to dump 500,000 cases of spoiled wine, a big cause of them losing $160 million here in the U.S. The CEO at the time had to resign, and they're now in a bit of a bidding war with competing private equity bids. I mentioned earlier the broker consolidation going on. The broker's role is pivotal between the manufacturer, distributor, and operator. And we had done one of our previous Technomic talks on broker consolidation, so I don't want to spend a lot of time here. But suffice to say that the last 2 years, as I noted earlier, I've seen a great deal of activity as these organizations grow from local or regional players into national players. As the consolidation at the manufacturer and distributor level has occurred, it's only natural for sales organizations supporting and selling to these companies to need to achieve to grow scale. You see, and these are based on Food Institute and company reports, there have been 10 acquisitions in 2013 by Acosta, about 10 by Key Impact in 2013, 2014, 7 by Advantage Waypoint in 2013, 2014. And certainly these have also made these organizations very attractive to private equity. Costa was just acquired by Carlyle Group for about $4.8 billion, which follows on the heels of Advantage being acquired by Leonard Green and CVC Partners for over $4 billion. So a lot of private equity interest there as well. I noted earlier that many of the 2010-2011 numbers were driven by distribution M&A activity, and this looks back about 3 to 4 years to capture a great deal of activity. Nearly every major broadliner and even specialty players like McLean have been active in consolidating what still remains an extremely fragmented distribution market. You've got McLean, a division of Berkshire Hathaway, acquiring MBM in 2012, really helping solidify them in the chain distribution market. Cisco's made multiple acquisitions, not including the one we'll talk about proposed in a minute, which many of these were fill-in acquisitions or product category expertise and expansion play. U.S. Foods has acquired a number of places, GFS. Chef's Warehouse has had multiple acquisitions to expand its scope, including some broadline distribution business and a Vegas specialty food importer. So there's been almost $9 billion in distributor activity over the past several years. But the one deal that we're waiting on is the Cisco, call it a merger and acquisition of U.S. Foods. The deal was announced late last year, and if and when it closes, it's going to result in a food service distribution giant with some $65 billion in sales and an estimated 27% of the food service market. We're awaiting final regulatory approval on that, but assuming it comes, the merger will absolutely mean a big change in the food service industry, not only for distribution, but also for operators that perhaps had sourced from now and have lost a major option. Big changes for manufacturers who are losing a key customer and one of the counterweights against perhaps putting too many eggs in one basket. And so we're certainly keeping a close eye on what happens with Cisco and U.S. Foods. We've covered a lot of ground here, and I know we're at about 22 minutes or so. So let's just spend a minute to discuss the future and what we see happening over the next several years. What does the future hold? Well, I don't think it's going too far out on a limb to say that consolidation and additional acquisitions are going to continue. The absolute number of deals may not grow, but we believe that the transaction value will continue to be high, perhaps setting records again, not only this year, but in 2015 and beyond. The food industry is a mature and stable industry, granted low growth, but one that is a relatively safe investment and one which, if the right brands or technologies are acquired, can be extremely attractive and lucrative. But that alone doesn't tell us why we believe M&A activity will accelerate. The combination of the mature industry with a number of other reasons are why we see this trend continuing. One is activist investors looking to maximize investment. They may force companies to spin off underperforming assets. We've seen a lot more activist investors out there, and this is happening more and more, it seems, certainly in the restaurant business and in the processor business as two great examples. I mentioned earlier the cheap money and the historically low interest rates and the fact that major corporations and private equity are awash in cash. And really, to some degree, it's a seller's market. Given the conditions, there's probably a number of family-owned companies looking for an exit strategy. There's also a large inventory of companies owned by private equity firms that may be looking for liquidity given the strong M&A activity going on. Now, certainly there's a lot that can derail activity and can have an impact not only on M&A but the broader economy. And so the usual caveats apply. There's still a fair amount of economic uncertainty in the U.S. and in Europe and in Asia, heightened by a fair amount of global instability. Furthermore, increasing shareholder activism isn't always a boon to M&A activity. It can also threaten to force companies to return capital to investors rather than pursue M&A opportunities. And high share prices and stock market volatility forces companies to be wary of overpaying for acquisitions, although it certainly seems that multiples are very high and merger and acquisition activity certainly has not been impacted by the strong stock market. In fact, I think it's been helped by it. So with that, that really concludes our webinar on mergers and acquisitions. Thank you for your time. I do want to make note of the fact that we're pleased to continue the Technomic Talks webinar series in conjunction with IFTA. We've got one more scheduled for October 7th, Reaching Consumers on a New Level. And we're also pleased to continue the webinar series into the winter of 2014 and 2015. We're working to finalize the details of the next group of webinars, but we have decided on topics, and they are status of the chain business, transparency within the food industry, online sourcing, the cost environment, and change drivers and transformation trends. More details will be forthcoming on these, but thanks again for your time today, and we appreciate you participating in this webinar. If there are any questions, as I mentioned, please submit them on the website, and thank you again for participating.